After paying off $43,000 worth of debt and taking that momentum to a net worth over $850,000, looking back, I realized that the one most powerful thing that helped me do that is compounding interest. So in this video, I'm going to share why parents are missing out on this if you're just sitting in the sidelines, or if you think you're smarter than most people and you're trying to time the market to be in it at the right place. So first, let's start with why you should not be sitting on the sidelines with compounding for investing. First of all, a lot of people like to think about compounding just in the aspect of investing, having its money make more money, right? And that's super fun and sexy. But if you're in debt, that is also a compounding element as well. It's just negative compounding. You're literally compounding your wealth towards other people. So get rid of that as soon as possible. My rules are, when your money comes in, make sure you have an emergency reserve. I cannot stress this enough. Literally $1,500 at the time when my wife and I were paying off $43,000 of debt in 13 months. That's how we were able to push and, put as much money as possible towards the debt because we knew we had a little buffer. So have that. And then after that, we want to focus on the high interest debt. So this is anything over 7-8%. So yes, all the credit card debt. Get rid of that before investing, because when you look at the interest rate math, if you have a 25% credit card and you're getting return 8-10% in the stock market, something like that, obviously that's a horrible return. So compounding is in effect with debt as well. But today we're going to be talking about the positive side of it. So let's say you're starting at ground zero, you're starting at zero, right? And this calculator is forcing me to put $1 in here. So we're at $1. Depending on when you start, it's going to have the biggest impact. So let's just say for now, 20. Let's say you're 30, right? You're 30 years old right now watching this. 20 years later, okay, I like to use an estimated rate of return of 8%, typically in a standard, the US stock market over a long enough time horizon has basically yielded 10 to 12%. So I just like to be on the conservative side. And if you include inflation, blah, blah, blah. A lot of people don't consider that as well. So I like to just consider 8%. Now, this contribution amount is what we need to think about as well. The more we contribute, the more, money will be in our account. So the ways I like to think about it is time is a super important factor. And then contribution is the next important factor. So obviously, someone starting at 0 years old, if you invest every year for 60 years, something at 0 years old, you're going to be very, very rich, right? But obviously most people don't start at 0. So let's assume we're starting at 30 and our contribution amount is $500 a month. So that would bring us to a total of $294,000. Okay. Not great, not terrible though, but if you look at the graph, you can start to see what's happening. The blue line is the principal that we're paying, meaning the money, the $500 a month. And then the interest is the money that is compounding, creating its own effect. Right? And here's the interesting part. So you can see as we're scaling up here, the gap becomes different. And in the end of the 20 years, you've paid $120,000 by doing that $500 a month for 20 years, and the interest on that is $174,000. So it's really cool to see the moment when your money starts making itself more money. And we can go here until it happens right around this mark. So in 16 years in this example, the interest of the account is more than the principal of the account. So in 16 years, you put in $96,000. The interest was $97,000. Okay, but in today's world, that's probably not going to be enough to retire $300,000, right? So we have to look to how do we increase the time, meaning like prolong the amount of time that we're investing in, or add to the contribution amount. So even if I just change this to $1,000, and it more or less doubles, right, the total balance, which makes sense. Now, here's why time is the biggest leverage, because if we go back to the $500, and now if we do it for 30 years, you can see it tripled. An extra 10 years tripled, right? So now we've contributed $180,000 and our interest is $565,000. And let's see if it will flip around the same time. Yeah, that year 16, right? And then here's where we stopped last time, right here, after 20 years, right? And then look at all this impact after the 20 years, the next 10 years. And then if we make it $1,000, holy crap, guys, $1.5 million, right? So that's why time, one, is the most important thing. So if you're watching this video like, oh no, is it too late for me? Definitely not too late. But now we need to use the next element of how to catch up to that, which is adding to the contribution amount that we're doing every month. And inside my Wealthy Parent Program, there's a link below this video to book a call with me just to have a quick, friendly conversation. But what I do inside that program is I'm helping families find more money in their finances. That it definitely exists. It's in there, guys, so that you can put it towards more valuable things like saving money, paying off debt, investing for your retirement, investing for your kids' future education. So the link below is if you're interested in that. Now, what about the people that are sitting there saying, oh, I like to kind of dip in and out. I watch a lot of the news, and so right now there's a lot of things going on, and I don't feel comfortable investing in the market when all these world problems are happening. So I'm going to jump back in later on when I know that things are a little safer. So I just did a quick little search here, and basically what happens if you miss. Let me frame this a little better. Let's say you have a $10,000 investment over 20 to 30 years, okay? If you were to sit out of the market and you missed the 10 best days, your value in the market goes from, call it $70,000 to $30,000 if you miss the 10 best days over those like 20 years. Now that's pretty significant, 10 days. No one is skilled enough to understand when the 10 best days are, or even when the 10 worst days are. Because the stock market doesn't go up and down based on news necessarily. It goes on value, like the valuation. So when people panic sell, I see it all the time. They buy at the peak, they sell at the at the bottom, and it's just like that's why people think that the stock market doesn't work. But your goals aren't correct. Now, it depends on how you want to use markets. If you're trying to get rich quick, it's going to be a different strategy than trying to build wealth for your family over a long period of time. But just look at this, like if you were to $70,000, right? If you stayed invested every single day the whole time, and you just do this thing called dollar cost averaging, where you're putting the same amount of money over either the same periods of time, so whether that's like once a month, every couple weeks, etc. And if you miss the best 20 days, your return it's only $17,000, and it keeps going down and down and down. So it's worse and worse and worse, right? Literally over 50% gets cut out if you miss the 10 best days. And then for the people that are saying, oh, but the stock market is risky. Well, let me tell you, the stock market has a 100% recovery rate. 100% recovery rate. Tell me what things exist in this world that have such a high success rate. What do I mean by this? Every time the stock market goes down, or we see all the doom and gloom online or in the news about how the stock market has crashed and everything like that, like it eventually just fixes itself and goes to way higher points. So if we look at something that we were all, very heavily involved in, the pandemic was right around this period here. You can see this little peak or valley, right? That really end of March period, beginning of April was like the lowest point of the stock market, and it went down significantly, right? And a lot of people got out here. A lot of people didn't know what was going on. They thought the world was ending. Of course, it was kind of scary. A lot of people lost their homes, their jobs, their lives. So not a great time, right? But in terms of just looking at the data and just looking at the stock market, it recovered after, what is this? I don't know, 6 months, 9 months. And yeah, did it take time to get back up? Yes. But then after that, the next year, it basically added 50% of an increase, right? And then it went down again, but it goes up again. And recently, just like a week ago, we were at an all-time high again. So if we're at an all-time high, that just means that the stock market has recovered, and it's always recovered. And is it a guarantee for future results? Hell no, definitely not. But it is an indicator that, like, over the last, 30 years, this is just the S&P 500 that I'm looking at, which is kind of the gold standard of investing in the U.S. stock markets, the top 500 publicly traded companies. And we're investing in that if you invest in the S&P 500. And so if you invested in November 22nd, 1996 and stayed in the market until then, you'd have a 925% increase on your money. So that's basically 30 years staying in the market, and you have a massive, massive increase in your money. So this is why investing and compounding is so critical, and how my wife and I were able to build so much wealth is because of this 3 to 5 year window in our life where we crushed debt, we got rid of negative compounding, and then rolled that into positive compounding for us and our family. And next year, we're going to be net worth millionaires easily, no problem, because we've just followed a super simple plan. And if you're interested in trying to come up with your own super simple plan for your own family, check out the link below this video to have a friendly chat with me, just to kind of see where you're at, where you want to go, and we'll unlock the one thing keeping you stuck. And then we'll see, if the Wealthy Parent Program is a fit for you and for me. I don't accept everyone into the program. So if that's interesting, check that out. If not, you can just look at this video right here.